But we were going to talk about private equity and search funds. One of our panelists dropped out, which is kind of fortuitous because we're running over. So we're going to go for about 30 minutes talking about search funds.
This work? Okay, cool. How's everybody doing? All
Fantastic.
right.
By the way, it's 2:37, so we'll end around 3:10.
Whatever you like. By the way, I didn't have the term industrial porn on my bingo card today, so I don't know if you guys did, but anyway. So by way of background, my name's Dan Marcus. The best thing I can tell you about myself is that I don't have a podcast to plug today. No disrespect to those that do. But in all seriousness, I'm a corporate attorney, founder several times over, and also a professor at NYU. But I'll let these guys introduce themselves because they're more important than me.
Hi, I'm Gaurav Mehta. I'm the managing partner and founder of Meshach Capital. We're an independent sponsor focused on healthcare investing in the lower middle market. We look for companies that are innovative in nature and intend to be disrupting the healthcare system. My experience includes private equity investment banking for about 20 years.
Hi, Chris Ansey. Currently wear two hats, president of a broker-dealer, and I also consult with a London-based family office, both sides, sell side, buy side, primarily in private equity.
So considering this is your bailiwick, and I don't think because it's kind of a niche topic, I think it's probably good to define terms to start. So Gaurav, why don't, just for the benefit of everybody, can you just define search funds and independent sponsors and the distinction between the two and the nuances?
Yeah, so when you think about private equity funds or hedge funds, you hear the term fund, which usually means that they are raising capital in a fund that will have multiple investments, right? So they'll invest money into multiple companies. And that's traditional private equity, but for private only. An independent sponsor, the way it differs from a private equity fund is instead of having just a $200 or $1 billion fund where you're deploying capital, it's actually better for, I think, family offices and others, because what happens is a independent sponsor will raise capital and form an SPV specifically for a specific investment. And so why is that? What are the pros and cons of an independent sponsor deal? The pros are, if you're a family office or if you're an individual investor, you get immediate liquidity whenever that investment exits. You don't have to wait 10 years to see all your capital come back to you. The cons are, really on the independent sponsor side, having to make a case to a seller why they should go with you over a fund because you don't have committed capital. So that's kind of like when you think about kind of the pros and cons, that's how I would say is independent sponsor. The search fund and how it differs from an independent sponsor is a search fund is somebody who is looking to go and acquire a business and form an SPV to acquire it, but then operate it as a CEO or president or some form as an operator. It's become increasingly popular more recently as, I guess, Gen Z and millennials graduating from business school are looking for an alternative to going up the corporate ladder. And given all the baby boomer businesses today that are kind of like looking for an exit, this is a great opportunity for a lot of guys who want to be an operator to go in and acquire a business and operate. And so people will go out and raise money to go fund their search. And as an investor, you get an option to participate in whatever they find down the road, and you get the first dibs. And I can go into more detail on both of those if you have any questions, but that's it.
Yeah, actually, that's a good segue. On the topic of questions, I hope that I can make all of these an interactive session. So if you guys have a question or a comment, feel free to throw up a hand and I'll give you the mic. But I do want to start with search funds. Chris, you and I spoke a lot about this before. The idea, well, let me preface by saying I read an article recently from CNBC that said over half of the small businesses in this country are owned by people 55 and over. And a lot of those are in like unsexy businesses, whether that be plumbing, HVAC, pest control, you name it. And a lot of the people that are going into that are starting search funds are MBAs who don't really have expertise in these areas. So Chris, can you, for lack of a better way to put it, explain this phenomenon to me?
Well, it kind of reminds me of an old Dilbert cartoon where this girl walks into the boss and says, I need a promotion. And he goes, to what? She goes, senior marketing director. He goes, how long have you been here? And she goes, 4 days. So you have a lot of kids that are coming out of school and, you know, as you rightly said, they're trying to get out of the corporate grind. If you look at Instagram or Twitter or whatever, we keep hearing that you should get into the pool cleaning business or the, you know,
Vending machines. Vending machines are huge. in the
vending
algorithm.
machines.
Yeah.
So it's this push for the trades. It's the push for, if I see a lot of HVAC roll-up deals. So there's a trend, and it could be with what we were talking about before with the onshoring, reshoring thing, where everybody's trying to get out of the traditional path and get into something that has proven revenues, annuity streams, and actually something for them to do for a living. Now, whether or not that they actually understand, you probably all have an uncle or a cousin or somebody who's a plumber. It's probably, you know, in the middle of the winter, if you're working on something like that, I don't think these kids have an idea that that's what they're in for. But I think that's what the trend is for sure.
Yeah, go ahead, Gora, if you've got something to say on it. I just think the irony is so palpable that instead of having to start a business from the ground up, they go and find money to start a business or to buy a business. And they're trying to get away from actually doing working, and they realize, oh, well, I might have to do some plumbing, or I might have to figure out how this business
And
works.
to continue with that, then you've got, you know, I think two panels ago, Marty, we had some guy from the Midwest. He's doing 30, 40 companies a year selling out, you know, with these third, fourth generation families that have been making screws, or they're, you know, some kind of sheet metal guys or something. And then their kids are selling these businesses to these primarily Northeastern or coastal kids, schools, graduates that they don't want to do anymore, when everybody should sit there and say, you probably should stay in the family legacy and continue on with that business.
So I'm painting with a broad brush. I know, obviously, as someone who does this, it's a little bit more nuanced than that. So Gaurav, why don't you, can you speak about, with respect to search funds, like who's the ideal search fund operator, founder, and how do you go about finding your ideal founder operators?
Yeah, sure. So I'm going to speak to search funds first, which is a little bit different than the independent sponsor world, just to be very, very clear. The search fund operators, you find kind of two batches of folks who kind of come out and say, I want to go raise a search fund. The first batch, who we talked about earlier, is those new graduates out of MBA programs, your top 10, whatever schools, who are looking to do something other than corporate. And for everyone's benefit, actually search funds have the highest return ROI profile relative to other asset classes. And you can look at you can look up the Stanford website, talk a lot about search funds and that industry overall. And
is that a little bit of like propaganda, though, considering a business school where, you know, they're encouraging their students to go into that path? So is there like a grain of salt or a dose of penicillin you should take with Stanford?
I think you just got to know who you're investing behind. I think what it comes down to, and that goes with whether you're investing behind a PE fund manager, an independent sponsor, or a search fund operator. So anyhow, there's two batches. So there's the MBAs, right? And then the other batch are industry veterans. Those who are looking, they kind of reach a point in their career where they're not going to break that glass ceiling for whatever reason. Maybe they're not as politically astute as some of the folks that they work with, whatever the reason being. And they choose to go out and go acquire a company to go run it. And you see this all the time. And, you know, I think, you know, when you're thinking about investing behind somebody personally, I'd rather go with that industry veteran than the young person who's 25 or 27, doesn't really know anything about business. But the veteran who makes a decision to leave a successful career to go and operate a business, that person is probably going to have pretty high odds of success relative to that 27-year-old. So that batch is also pretty active right now. I get phone calls all the time from industry veterans asking me about, hey, I want to do a search fund. What do you recommend I do? And I give, of course, free unsolicited advice. But like, you know, sort of, those are the two batches. I'd say look for the second batch, in my personal opinion, if you're going to back somebody. Now, going to independent sponsors, how are we different? We're not looking to operate. We're looking to build a portfolio of companies. So when you're backing an independent sponsor, you really want to get somebody who's an industry expert. There's like two batches of independent sponsors too. There's the generalists who are like, I got a deal and let me go get some economics because I brought this interesting deal. They don't know nothing about the industry. And there's plenty of those guys. I would never back someone like that personally with my own money. And then there's the other batch, which are industry veterans, people who invested in the sector, understand all the nuances of what's going on, take an active role post-close. Again, similar batch, like that's the folks you want to back. They're going to have a lot higher success rate, and they typically have operators, such as search fund guys, who want to go in and operate a company. And so that's the value. They bring more value than just a deal.
Is there not a third category? Like that third category is, I feel like the one that you want the most is people that have started a business before, or is because they have that skill set, they're not in the same talent pool.
What I have found is if you've been a successful entrepreneur, it's like they're like serial entrepreneurs. They're not really going out and doing search funds, right? They have made their money on their first exit. They're looking to deploy it. They might bring in some of their own network folks to help fund the next venture. But generally speaking, search funds are really kind of geared around guys who have maybe not made all their money yet.
Yeah, fair enough. Chris, as someone who's been on the basically the sales side a lot before, or just at least on the capital side, how do you vet, whether it's a search fund or an independent sponsor, how do you vet someone who's bringing you a deal like this?
We have not come across search funds per se. That they have not tapped us, on the sell side. But I'm currently working on an independent sponsor deal now. Very, very sharp woman, been around for a long time, and she's putting together 5 different companies that will then eventually create a vertically integrated platform, which at least on paper blows up pretty nicely. And the business itself is a phenomenal demographic. Sometimes you can look at the independent sponsor model as kind of like a non-public SPAC. And for those of us who are old enough to remember, they were called blank check companies back in the day. And the original blank check companies were, like you mentioned, industry professionals going out and taking over a company in their vertical. Then you've got the second wave of this SPAC thing where private equity was launching them, and they were just looking for the most attractive companies to go and take in that model. So the independent sponsor model is working both ways as well. You have people that are industry agnostic. They're just looking for something that blows up on the paper. And then you've got guys who are like veterans in that particular business, and they're bringing their expertise to grow it. So I think that it's kind of a jump ball on how they could kind of work out. I think my money would be a little bit more in the industry guys, but because they may have more contacts and they may understand the nuances of the business. And then when you go back to search funds, I think experience matters, because as we were joking about before, a lot of these trade related businesses, and I don't know what you're seeing on the search fund side, but a lot of these trade related businesses, they're difficult and hard to manage, and they can be people intensive. I know of one particularly that when they overexpanded, and now there's a parking lot with 12 plumbing trucks that nobody's driving. So I think again, at the end of the day, if you're looking at any of these things, you got to do your due diligence and your homework on who it is that's running the product.
The advantage of the search fund is that it has capital.
Yes. Well, it has a revenue stream. So I think it's a little bit de-risked if you're going out trying to buy an established business that's, got a clientele.
When you're an independent sponsor, you have to go and
Oh, yeah. Yes. That's the differentiation.
Well,
there.
they don't have capital to deploy. They have capital. It's pseudo to deploy. You typically what it is, you'll raise like $100,000 for a search. And in exchange for that, your investors who come in get an option to participate in something you bring to them. That's usually how they're mostly structured, from my understanding. So it's not quite there. It's like okay.
I think the general theme that I heard is that experience matters, whether you're operating a business or theoretically running a city like New York. But I guess that's just one man's opinion. Nevertheless, veering away from politics. So, as far as like what kinds of deals are getting done, or like what kind of sectors you're seeing that are not the cliche or the obvious ones that you hear about, whether it's via the algorithm or generally in private equity, or what kinds of ones that are you seeing that are outside the cliche, and then where is their opportunity?
So it's interesting. While I focus on healthcare, we are helping a large asset manager liquidate their private equity portfolio right now. It's in the infrastructure services space, and I've taken a crash course on 101 on it pretty quickly.
What does that mean in English?
Yeah, so infrastructure services. If you think about all of our infrastructure around us, we're in infrastructure right now in a building, but roads, highways, sewage pipelines, data centers, et cetera, et cetera, et cetera, right? Like there is an enormous amount of investment capital going into infrastructure right now, particularly with the Trump administration and where their priorities are. And so there's an enormous number of service companies that help make all those things happen, right? When you think about a road or a building, one of the services you got to do is figure out what's underneath the ground, right? What gas pipelines are there? What electric pipelines are there? What fiber lines are there? And so there's companies like locate services companies, which is a deal I'm working on right now, which I never knew even existed until this most recent opportunity. And it's a fascinating business. It's dominated by two major players, the sector, and then a whole fragmented industry of thousands of players who take a small market share. But the point of it is like what we're seeing is a massive amount of growth driven by AI. You may say, what does AI have to do with infrastructure? Actually, it has a lot to do with infrastructure because AI is a big consumer of energy. AI is a big needs lots of fiber. So if you think about all the stuff that enables AI, there's obviously a lot there. And so the infrastructure sector overall is just seeing just a tremendous amount of growth and all the services around it. So that's one area of interest. Healthcare, I'd say, as much as I'm being negative on my own sector, I'd say like anything regulated around Medicaid in particular, or Medicare is kind of we're in no man's land right now. We want to figure out where the dollars go. And so I think, sector specific within healthcare areas that are interesting are pharma services, employer-sponsored healthcare, and of course the continued drug development pipeline if you're interested in taking on clinical risk. Those
Chris,
are just a couple sectors.
Sorry, I didn't mean to step on your toes. Chris, what about you as far as private equity in general, outside of the cliche ones that we always joke about?
Well, I agree that the service businesses, I think, are very compelling for people. We have come across quite a bit of people trying to do RIA roll-ups. Again, the economics on that business, there's been a lot of consolidating of fees. So a couple of years ago, I think if you had, 400 or 500 million as an independent RIA, you can make a living. Now that number's gone up. So everyone's kind of rolling up into bigger shops. We've seen accounting firms roll up and stuff like that. So, but I agree with you on the servicing side. I was just hearing a story about these farms along the Jersey Turnpike or something, and they have fiber connect, like the fiber runs along the farm, and then the farmers were selling that piece of the land so people could tap the fiber. I don't know exactly how they were able to do that, but I think that's very interesting when it comes into like AI specifically. We're talking to two different groups. One guy's trying to put together megawatt powers. They're looking at two old towns out west that were sawmills. And apparently they've got all the infrastructure in place to carry some megawatts or gigawatts from an old hydro plant. I mean, that to your point, there's a lot of activity going on that front. And then I also have a coal plant in Pennsylvania that's being turned back on. They turned it off like a half a year, like 6 to 8 months ago, and we can turn it back on. And so again, to your point about the services, there's a lot of guys that we got to bring in there in order to get that back on and stuff like that. So
yeah, in my opinion, the best way to play AI is not play AI. Think about the gold rush of the 1800s. Sort of play the picks and shovels. So all the stuff that enables AI is where you want to play.
So I feel like with private equity in general, the thesis is always there's going to be someone that's bigger that's going to buy whatever you're going to consolidate on a smaller level. Is that true indefinitely? Because a better way to put this is that are there always going to be proverbial dance partners that will support your thesis of whatever consolidation roll-up efficiency?
I think that's one of the problems that we're facing right now. We were talking earlier, I've got customers in a couple of privates, and one of them joked and says, I get 13K ones a year and I haven't seen a distribution. So the industry has come up with continuation vehicles, which is extending these things another 5 years after you've been in already 7 to 10 years. So the expectation that there was a dance partner, I think is hit everybody over the head, where the four corners of the document in your PPM says that this is by nature an illiquid security. Everyone's finding out pretty quickly that it is illiquid. And there is no guarantee that some of the bigger guys are going to come and scoop you in at the proverbial 10x that everybody, originally said that they were worth.
Gaurav?
share the same sentiment. I mean, in healthcare, you're seeing all these DSOs and PPM, physician practice management companies. You know, like the thesis was, oh, just roll up a bunch of physicians together, sell it to another private equity firm, and eventually it'll get bought out or go public. That thesis is dead. So definitely seeing the same characteristics in healthcare.
And what we're doing on our front now, when the fish were jumping in the boat on private equity deals, quote unquote, or SPVs, now you have to be very strategic. And if you're looking for healthcare or something, you got to bring in investors who are 80 yards down the field. They understand the product, they understand the vertical, and then making a decision is what they need to do in terms of allocation of capital. I think the day and age of everybody just running into these things is coming, to a very subtle end.
I feel like every time I do one of these with you, Chris, I learn a new platitude. Fish are jumping in the bucket. I don't know. Maybe it's a generation.
Did I say bucket? Uh-oh.
I don't know, but again, that's a new one. I'm gonna use all of these. So let me ask a follow up to this one. Is there, and I've used this phrase earlier in this conversation, is there a third door other than an acquire or an IPO for this thesis to make sense, as far as, whether it be private equity generally, independent sponsor, search fund, what have you?
I'm happy to take that one. So I think, it comes back to, recognizing that there may not be an exit doesn't mean it's a bad investment, right? There's dividends that you can pay out. So there's a lot of ways to sort of, monetize an investment that can make a lot of sense for an investor. If you're looking for a big payday, maybe that you don't want to be investing in something that may not have an exit down the road. But if you're looking for if you're a dividend investor, you like dividends, there's lots of ways to make money on these physician practice companies, and get yourself a, kind of annual dividend plus a recap, maybe every 5 years on a dividend recap. And so I just think there's, you just got to kind of keep an open mind. That's what I like about the independent sponsor world. Maybe it's self-serving for me to say this, but we can structure deals and bring in the right set of investors for a deal where it makes sense for both the founder and then also the investors who are coming in.
I feel like that's the only other answer. So you found, I like dividends too. So maybe this is like an old man yells at cloud kind of question, but what is wrong with this generation of kids that don't want to run a successful family business? Or is there something wrong with this? Like, how do you explain this phenomenon where there is, I guess, a lack of succession? And neither of you are psychologists or sociologists, so maybe there isn't a right answer, but I kind of want to.
Well, I think it's the American dream, right? I think that most parents want their kids to do quote unquote better than they did. I mean, somebody quoted The Godfather before, and we all know he wanted Michael to run for office, right? So it didn't work out that way. But everybody, I think,
I don't know if that's a good analogy because he was a criminal, so of course he didn't want to become a criminal.
But anyway, everybody kind of if you've been in the HVAC business or the making screw business or sheet metal business and whatever, and your kids, third generation, they've all gone to college or whatever. I don't know if it may be just a perceptional thing where they just don't want to see their kids carried on, even though it may or may not be the smartest thing for them to do.
Oh, we have a question. I love questions. Hold on. I'll come to you. Don't worry about it. This is when I get to do my Oprah thing. Sorry, Marty. I know I'm not on camera. Actually, that's probably a benefit. All right. Tell everybody your name.
Hi, I'm Tatiana. It's not actually a question, it's more a comment as the fifth generation. So we've been through a lot. I'm from Brazil, I'm fifth generation, and I'm now the successor of my family, but something really bad had to happen for my father, for example, to see me as his successor. So I think a number of factors play. I think in lots of families that happens, though, you want your kids to do what they want to do, follow their dreams and, carry the heritage and all of that. But my dad suffered a car crash last year and he almost died. He was in really bad shape and he had to, he couldn't walk. He broke 2 spine bones, 2 ribs, his hip in 3 places. So I stopped my entire life. I work in finance. I have an advisory company that represents fund managers set up their businesses in Brazil. But I had to stop everything that I was doing to come home and help him recover. And it was a very long recovery. So it took him 8 months to walk again. And then I told my dad, if you had died, you would have put me in a really difficult position because I am your successor, either you like it or not. He has 2 girls, so me and my sister. And my sister is a doctor. She has 2 girls. I'm sorry, 2 boys, and I have no kids. So, and I work in finance. So basically, if he had died, there would not be another option. Like I would be the one leading the business because my sister doesn't have, you know, the lifestyle or the knowledge to do so. And my mom handed over her own inheritance for my dad to manage. So when he did suffer this accident, I took several courses on succession and said, listen, and it was something I was trying to do for years. It was like, Dad, let's plan succession. Let's plan succession. And it was like, oh, you're you know, gold digger that just wants my money to travel and spend on, you know, jewelry and clothes. Yes. Yeah, yeah. But I mean, you know, I think like I know you're single too, Camille. So yeah, the answer is yes. But anyway, what I want to bring with this is like succession is something that needs to be, you know, not just planned in terms of businesses, but also like I read this book that I really liked and took some courses on succession, and one of the books is Family Wealth. And it's more important for you to think of preserving the human capital than just thinking of assets, because money can be lost, but what really preserves capital is the human you know, the human capital, because a business can go bankrupt, but if you have human capital, you can, you know, rebuild businesses and move forward. But that's what I wanted to share.
That's really fantastic.
That was awesome. She's not a plant, by the way, but that just happened to like walk right into it. So
we have 1
thank
minute
you.
left.
Huh? We have 1 minute left.
Yeah.
Can I ask then the follow-up question, and you guys can plug whatever you want when you're done looking at your phones? Is what was the business?
Yeah, so my great-grandfather, he founded several business in Brazil. He founded a textile company called Ferreira Guimarães, and then he founded a mining company called Magnazite, and the Bank of Minas Gerais. And then we diversified into other segments. So my dad, he's the responsible for managing the agribusiness portfolio for his family. So his siblings and my mom's inheritance in agribusiness as well. So after the accident, I helped my dad and my mom, like our, you know, single family, to diversify the portfolio and plan for succession.
We only had a minute, Marty, so I'll honor that minute. But I if we had more, I'd have a bunch more follow-up questions. But thank you. Awesome. Well, I can only wrap up by saying or asking the following: if you guys have anything else that you would like to plug, now is your opportunity. If you guys like Hot Ones, camera here, camera there, camera there. Maybe that's a generational thing too. Anyway, go ahead. And if not, I could wrap it up.
Yeah, no, look, I think if you have any questions regarding kind of independent sponsors, search funds, happy to, you know, take questions in the back, whatever after those.
And then I'll just end up like at some point there's going to be a break in the dam here where a lot of these things are going to begin to turn over. It's been 2.5, 3 years where there's been a little bit of a lull, but at some point there's going to be events and there's going to be a lot of opportunity out there. And with the advent of search funds, independent sponsor funds, traditional PE, what you do know is the American financial markets are always moving and trying to figure something out for people. So,
okay. Thank you guys. Give it up for these guys and for Tatiana.
Our guest speaker. I think Peter Lewis is here, and we're going to get started with Peter Lewis talking about